Today we will talk about global risk transmission to local financial conditions and the participation of foreign investors in emerging market economies, sovereign bond markets. Today we have recurrent financial volatility episodes and a geopolitical situation that redefines capital flows. In this context, emerging economies are facing a less benign context for external investment with more susceptibility to risks. In Colombia, since 2014, with the massive entry of foreign investors for TES government bonds, there has been a change with more liquidity, but with a more direct global risk transmission and exposure to external shocks. So how can we profit from financial integration without giving rise to high volatility? So there is a direct relationship between fixed interest rate, capital mobility, and independent monetary policy. Today, however, we see some evidence, according to Helen Reagan, in the face of total capital opening, this can lead to a dilemma. Global financial conditions may be transmitted through capital flows and the price of assets. So the paper that will now be presented by the Banco de la República shows that during the years of more foreign investor participation, there was an increase in risk concerning exposure to external shocks. In this case, home currencies play a key role. On the one hand, this has been critical for emerging economies to reduce reliance on foreign exchange denominated debt, increasing foreign investor base and handling financial conditions. However, more foreign investor participation in these markets can also become a potential channel for global risk transmission to internal financial conditions with some subsequent shocks. However, this can also lead to resilience. So this paper is particularly interesting despite the challenges imposed by global conditions. Colombia had a very solid institutional framework of offering exchange rate flexibility and robust buffers, as well as inflation targeting. Therefore, this process was quite orderly without jeopardizing stability. That's how we can carry out this discussion, not only concerning capital markets, but also concerning how we can optimize macro financial stability. In order to discuss these topics concerning macroeconomic and financial stability, we have Andres Musia with us, who is Chief Officer for Monetary Operations and International Investments at the Central Bank of Colombia and co-author of this paper. This discussion will also be carried out by Alonso Alfaro, Chief Economist at the Central Bank of Costa Rica. So Andres, I would like to start with you so that you can share with us the details of this research paper. Thank you very much, Yader. I'm very excited to be here at this webinar hosted by FLAR. Let me start out by sharing my screen. Could you please confirm that you can all see my shared screen? Thank you. Not yet, Andres. So that you can now see my screen. Well, once again, thank you very much for having me. Today I'm going to be presenting this paper that was recently published And this is our contribution by the bank after the BIS governors meeting. And the authors of this paper are Oscar Botero Ramirez and Andres Murcia. We are going to be presenting as well some personal opinions, but this is not the opinion of the central bank's governing board or its officials. This paper is also authored by Hernando Vargas Herrera. When talking about the sovereign bond market, this is critical for capital flows. And in Colombia, this market was characterized by high liquidity, and this is very important for financing the current account of the balance of payments. This market is therefore highly important and a centerpiece to financing and good functioning of the different markets. So as for the transmission of external shocks to the domestic market was characterized by some sensitivity and different external shocks therefore affected the Colombian economy. As for foreign investors in the market, they underwent significant changes, showing some key variations. As a result, financial conditions changed and became vulnerable to external shocks. We have solid information at the central bank in terms of foreign investors' holdings, and we can therefore ratify this hypothesis when talking about sensitivity to local conditions or external conditions. All this is also contained in the literature, and this explains how Colombia may be exposed to these external shocks. So this is the background of our work. Now let me talk about foreign investors in Colombia's sovereign bond market. This research paper is based upon the sovereign bond market. Here we are talking about the spot market. We are talking about government bonds denominated in home currency. And these may be related to different market stakeholders. Prior to 2010, foreign participation was negligible, standing at around 1%. And investors did not play a very significant role in the domestic market. Only 1% of investors were foreign investors. Afterwards, in 2014, some major reforms took place concerning taxation, and other FDI changes occurred as well, giving rise to more favorable conditions to foster investment flows. As a result, Colombia's reweighting in the JP Morgan GBI-EM index triggered large inflows because it shifted from 3% to 8%, as you can see on the graph on the left. So this government bond reweighting change on this index was quite significant. This is a key global index, a very significant index globally speaking. As a result, foreign investors began to pay attention to the Colombian market, bringing in around 8 to 9 billion US dollars into the Colombian market, because these investors wanted to invest in Colombian sovereign bonds in one way or another, trying to replicate the index as such. So by trying to replicate this GBI-EM index, they stepped into the Colombian market very actively, accounting for a share of 25%, as you can see on the right-hand side. So we shifted all the way up to 25%, and that is the highest foreign investor participation in the domestic market. And they became the second most important government bond holders in the country, following mutual funds with a very constant share. There were not significant outflows by foreign investors, not even during the pandemic. And just recently, there has been a reduction in terms of the holdings of foreign investors in the local currency, dropping down to 15% from that 25% posted in 2025. However, this outflow or this retrenchment was a gradual one. However, it was quite significant, and this is due to several local and foreign factors. Nonetheless, we should underscore that in recent times, tax conditions have deteriorated, and the fiscal anchor that Colombia had waned. Therefore, local government bonds lost their investment grade status. All such factors contributed to this environment where we see foreign investors leaving the local market, and this was also fueled by a more uncertain international landscape. As a result, there was a change in the foreign investors' structure. Now, what happened afterwards? Now, let's go back a little bit further. What happened when foreign investors came into the local market massively? Well, on the one hand, huge profits flooded the domestic market, leading to more liquidity in the market, more depth, and more heterogeneity among investors, creating financial conditions that were positively amplified with lower financing costs. So the entry of these international foreign investors into the local market was quite positive. Nonetheless, this also triggered more risks or other considerations that we need to factor in. For example, when you have more foreign investors coming in, that can lead to more sensitivity of financial conditions to other variables or to other agents in the market, in the local market. A few years ago, we conducted another research work, and we showed that the increase of foreign investors in the domestic market eased up financial conditions, leading to lower financing costs at a national level, which is afterwards, of course, passed through to other players such as corporations or institutions whose funding costs are also reduced, because those funding costs are related to sovereign funding costs. In this section, we focused on the investor composition. Very often we speak about international investors, and we tend to bring them all into the same bucket. However, the investor composition as such is very important. We have thorough information, granular information as to who are the holders of bonds at each point in time. Therefore, we can analyze the behavior of these investors in the local market. Gamboa and Sanchez, back in 2024, they pointed out to the fact that mutual funds are more sensitive to global financial shocks, as well as their investment decisions. And therefore, international variables may have a direct impact on this group when it comes to investing decision-making. Other players or stakeholders, such as mutual funds or sovereign funds or long-term bond holders, are take into account idiosyncratic aspects, and they're not very reactive in the face of international shocks. This is quite an interesting insight because it shows that sensitivity may vary according to international investors' profiles. Back in 2025, Ocampo also found that a higher participation of mutual funds increases yield volatility at shorter maturities and leads to more frequent and abrupt portfolio reversals. That is to say, a kind of sensitivity that moves in the same direction. Some time ago, last year specifically, together with Botero, Murcia, and Villamizar, we explored the heterogeneity between those investors that follow the so-called indexes or the so-called benchmark-driven investors, such as GBI, which play a very important role, and others that may follow other indices but are not benchmark-driven investors. When comparing their behavior, we have observed some differences. On the other hand, those banks that have a direct relationship with different investor profiles are also affected by such heterogeneity. Therefore, those banks with a more direct relationship with non-benchmark driven investors are more sensitive to the entry of capital flows. Usually credit supply is sensitive to investors, especially in the case of banks, and this has an impact on their balance sheet. So we have measured local financial conditions by applying an index that is widely known at the bank. It's called IDOAM. IDOAM is the department responsible for analyzing market conditions. It's a very straightforward index that aggregates different financial conditions, taking into account interest rate and credit spreads. It also covers confidence indicators, exchange rate and asset price volatility, as well as some expectations or results from confidence surveys conducted by different players or stakeholders. It's quite interesting because this index is highly related to aggregate demand. And not only that, it also has it also allows for some predictability of aggregate demand as depicted on this graph. So whenever financial conditions are broader, that's when aggregate demand tends to grow more. And the opposite happens as well. When financial conditions are tighter, well, aggregate demand tends to dwindle. We have run this regressive vector exercise between 2011 and 2025. This is the monthly VAR estimated during this period, with a global risk indicator constructed as a first principal component of the so-called VIX, MOVE DXY, and the EMCDS spreads of the different countries. We therefore assess sensitivity of local financial conditions in the face of different scenarios. We take into account the scenario where there was low foreign investor participation between 2011 and 2013, then the period of high foreign investor participation during 2014 and 2022, and then we analyze the period of declining participation after 2022. After running this VAR exercise, we found that prior to 2014 and prior to foreign investors coming into the local financial market, financial conditions would not react in the face of global risk shocks. These markets were very much concentrated among local investors, and therefore external shocks would not affect local financial conditions severely. And that happened prior to this higher foreign investor participation. However, when this participation increased significantly, global shocks can lead to tightening financial conditions in the local market, as depicted in the graph right in the middle. When foreign investors have high participation, we observe higher global shocks leading to tightening or tighter financial conditions, and those tightening conditions may persist over time. Then when there is a reduction in foreign investor participation, this leads to a short-term effect. It's significant during the first period, but then it fades out. Here we see that local financial conditions are less sensitive to these investors, given the fact that these investors leave gradually the market. We also analyzed another indicator concerning local sovereign bonds, the rates applied to these sovereign bonds. As I said before, this market is very important in Colombia. It's highly liquid, it's very significant and deep. Therefore, we carry out the same estimate. Prior to 2014, we found that in the face of a global shock, some significant fallout may take place. And this is, however, relatively low compared to other periods. Nonetheless, we do see some shocks affecting the rates applied to government bonds. After 2014 and 2022, we observe significant effects on government bonds coming from external shocks. Most recently, these shocks became even greater. This is something that we will explain later. In the face of foreign investor retrenchment, in this particular market, here we are not talking about broader local financial conditions. In the case of Colombian government bonds or TES, we see some changes taking place in the most recent scenario. Therefore, we asked ourselves why such effects arose relative to the rates applied to Colombian government bonds. So this is one of the questions that we asked ourselves. And here's the answer. We believe that this happens through portfolios. So if we go back to the recent period, we have observed more fiscal deterioration. So foreign investors tend to leave. And who is going to buy the bonds that investors are selling? Well, local investors buy those bonds. Therefore, we see more local investors buying more bonds. Therefore, they increase their holdings on their portfolios. As a result, we observe a greater cost of opportunity if we compare the holdings of these assets compared to other local holdings. And since this local portfolio owned by domestic investors normally mm, lead to more risk, more sensitivity, and investors expect a higher remuneration. They are also more sensitive to global shocks because of this portfolio channel factor. This explains why agents may uh, ask for greater yields and why these external shocks may become particularly important when foreign investors leave the local market. Okay, so here we have some conclusions. Foreign investor participation has brought significant benefits, more market depth, more liquidity, more diversification as for bondholders, and diversified holdings, but it has also led to vulnerabilities or increased sensitivity to external shocks affecting local financial conditions. So these are some of the pros and cons arising from higher foreign investor participation. Since 2014, foreign inflows deepened the market, reducing financing costs, and they supported the issuance of long-term local currency debt. I mentioned this at the beginning. There is right now an ongoing discussion around the original sin, whereby emerging markets could not issue any bonds denominated in home currency, and therefore they had to become or obtain debt abroad. So if they are able to issue bonds in the local market pegged to the local currency, and if foreign investors would buy those bonds, well, for many, that was the best way to overcome that original sin. However, experience has proven just the opposite, because you have more exposure to these foreign investors who very often do not take out any hedges on the exchange, foreign exchange market. Therefore, they assume the foreign exchange risk firsthand. However, the sensitivity of these agents to global shocks that are not under their control gives rise to more sensitivity. And this is all to be priced in, of course. Now, the decline in foreign holdings that we observed in the Colombian market has somehow reduced this sensitivity. We highlight this matter in our research paper. As a matter of fact, our policy framework, our external buffers, foreign exchange flexibility, such an approach has enabled us to face different scenarios. So the fact that foreign investors left the market did not affect us much, because this all happened in a very orderly manner with no stress whatsoever. This is the result of a rock solid policy framework. We are going to continue overseeing foreign investor composition and their behavior in the market in order to understand how shocks are passed through and how they can affect local financial conditions. So that's all concerning the contents of this paper, and now I would be glad to answer any questions. Thank you very much for laying the groundwork both at a local and regional level. Thank you very much for sharing this data. And thank you for allowing us to understand the composition of the local markets participants, especially in the case of the Case Colombia government bonds. Alonso, please go ahead. He's going to discuss some of the highlights of Andres Murcia's presentation. Well, thank you very much for having me. Thank you very much, Yader and Carlos. And I would also like to express my gratitude to Andres for such an interesting and clear presentation. I would also like to say that I'm going to be expressing my own opinion here, and this is not necessarily the opinion of the Central Bank of Costa Rica. Let me start out with a quick summary of Andres' presentation. The research paper he presented shows that foreign investor participation rose thanks to the reweighting of the GBIEM index, shifting from 1% all the way out to 25%, posting a very significant increase. This reduced yields and therefore financing costs. All this increased the sensitivity to global financial shocks. During this period, when foreign investor participation was higher, global shocks affected local financial conditions more severely. Now, something that really called my attention here, and I would like to underscore this aspect. The foreign investor characteristics do matter here because mutual funds are usually more sensitive to global shocks and they tend to behave in a pro-cyclical manner. As for international pension funds, they are more responsive to domestic fundamentals with longer investment horizons. Since 2023, foreign investor participation has been sliding down, standing at around 15% due to fiscal deterioration and due to the loss of the investment grade status and also some restrictive global conditions. I believe that this is all very important for the region as a whole, not only for Colombia, but also Costa Rica and other countries that are trying to make progress in this respect. Therefore, the policy framework of the Banco de la República based on flexible MI, flexible foreign exchange, currency and robust international reserves. All this has proven to be quite effective to manage all these risks. And I think that this is quite positive. In recent times, Latin American countries are have tried to provide a better response in the face of global shocks because their frameworks have been modernized. In the case of Costa Rica, we have been doing this just recently. We, of course, have inflation targeting policies. We have been working to provide flexible foreign exchange policies since 2015. Back in the day, there was a ban in place that was valid until 2018. This process has been up and running in many other countries for a longer period of time. And I think that this approach has enabled us to withstand all the many global shocks that we had to weather over the past few years. On the other hand, Costa Rica can assimilate a certain number of best practices. In the case of financial markets development, we are taking some baby steps right now. We are not as integrated as Colombia is in this respect. And this document that Andres presented today and others developed by the Banco de la República proved to be very effective for economies such as ours. So we are two countries, we are both OECD countries, and we are analyzing the best practices that have led to more stable growth across the economies. And this is one of the takeaway lessons here. In general, this research paper is a story about portfolio behavior. In the past, we would have talked about when capital flows were to be controlled. That was the way in which public policy making was normally approached in order to tackle global shocks, and that might sometimes lead to balance of payment crisis affecting growth and pushing inflation up. Fortunately, public policy making has now been coexisting with these capital flows and these global shocks. And this is all possible thanks to robust policy-making frameworks, as well as inflation targeting policies and foreign exchange flexibility. And then we have, of course, taxation and the central bank that needs to implement the right measures. So when there is a higher foreign investor participation, financing costs should be reduced, margins or yields should be higher. When Costa Rica, for example, has to pay huge amounts of interest relative to other countries that have a much bigger debt overhang or a much higher GDP debt ratio. So I believe that this progress in terms of public policy making has been quite positive. In savings have also been critical. Pension funds have been developed over the past 20 years, and they have become increasingly more important. Now the country's net foreign position tended to be negative, historically speaking, but this has moderated over the past few years. It's still negative, but it has improved slightly. And I think that this is thanks to our current interaction with international markets. In Costa Rica, we know exactly how much, how many funds we can hold abroad. And let me make another comment here. Sometimes capital flows are not only related to fundamentals. In the case of Costa Rica, they may also be related to some legal restrictions that we had to coexist with. And during the Q&A session, we are going to discuss what happens with a dollarized economy. You know that 1/3 of deposits and credits in Costa Rica are denominated in US dollars, as well as wealth in general. So in an economy with such characteristics, you have to be particularly careful because this can have an impact on interest rates. Now, when talking about the financial market integration, whether we speak about Colombia or the rest of the world, some progress has been made over the past years. Now we can build information, as Andres pointed out, that there is plenty, a wealth of information that can be used for analysis purposes. In Costa Rica, flows have to do with the central government's public debt. However, this is relatively low if we take into account FDI flows. And this is due to the fact that the financial sector is not very deep, where the government has a high participation and not many private bonds, or the stock exchange is not well developed yet. It's just too young. On the other hand, even though we do have hedging mechanisms in place, we still need to reinforce these hedging mechanisms, and the fact that we have foreign exchange flexibility doesn't mean that we have completed this job. Actually, we still need more flexibility for investors to take decisions when it comes to investing. And in Costa Rica, of course, this should not become a risk to be borne by the central bank, because that will eventually lead to negative consequences. All these good practices learned from other countries, such as Colombia, may lead us to reduce our country risk and therefore integrate ourselves to the international markets. However, we need to move along, taking into account that unless we are careful in doing all this, international macro risks may be heightened. From a methodological perspective, something that pulled my attention, well, actually, many people at the Central Bank of Costa Rica read this paper, and we have exchanged our insights. Let me present you with a summary of the conclusions we have drawn. There are a few observations for some particular periods, particularly for the first period, and maybe that should be further discussed. We should discuss whether all this information is robust enough for this period. It's no doubt that the most important period is the one right in the middle, when foreign investor participation was high. Going forward, what future considerations could we make? Well, a VAR was used. Well, in the future, we could use instead an SVAR in order to supplement the document with new insights in order to render the paper more robust. Another financial variable could be foreign exchange rate. Of course, building on the work already done. And then I have some doubt, maybe that's because I do not belong to the Central Bank of Colombia. Andres spoke about an index that I couldn't find in any other place. The paper, however, explains how this index works. I would like to know whether this index was built for a particular research work, as stated in the appendix or exhibit to the document. So these are the thoughts that I wanted to share with you, and I believe that we'll be able to discuss this further during the Q&A session. Thank you very much, Alonso, for your insights, because you have provided us with an amplified view of the regional situation, specifically what is happening in Costa Rica and the discussions that we should have going forward. Andres, would you like to share any feedback concerning Alonso's comments? Well, thank you very much, Yader, and thank you very much, Alonso, for such interesting insights and remarks. Let me just say that IDOAM is not statistical information that we publish, even though we could ideally do so. We use this indicator as part of a public document that we have to submit to authorities every month. This indicator shows what happens in the markets in terms of inflation rates, monetary policies, yield curves, how foreign investors behave in the market. So this is a publicly disclosed document that contains, therefore, this IDOAM index. However, this is not an official formula. However, we could include it in our statistics because, as you have pointed out, Alonso, by doing so, we could add more value to our measurements. We could also use the foreign exchange rate as another variable to calculate the VAR. We have not included the structural VAR. We conducted some exercises and some local projections to analyze the effects, and eventually we opted to apply the VAR. We are aware of the fact that we're missing some data for the first period. We just collated some monthly data for the purposes of this paper. So thank you very much for your insights, because you represent the central bank of a country that went through a very important tightening exercise to build a new policy framework. So I would like to emphasize the progress made by Costa Rica to reinforce its policy-making framework. I believe that Costa Rica has grown stronger, accessing the IMF flexible credit line just recently, which shows that your policy-making framework is robust. We are already part of that club, as I said before. I think that this debate is quite positive. So thank you very much. Thank you, Andres, for your feedback. Well, after Andres' presentation and Alonso's remarks, we are going to start with the Q&A session. We have gathered some questions that have been posted by some attendees when they enrolled to attend this webinar. So let me start out with Andres. I believe that there is a great deal of interest around the inflation targeting regime and the external buffers, as well as foreign exchange flexibility, have all been key when talking about local financial conditions. So can you shed us more light about the related risks that might come from the global markets? Well, thank you very much. And also in line with Alonso's remarks, I believe that our policy making framework is critical. We have this inflation targeting regime in place with foreign exchange flexibility being key. And I would like to underscore this foreign exchange rate flexibility. Our goal is to have clear-cut targets, and that is our interest rate, of course, as well as foreign exchange flexibility, because all this very well defines our policy-making framework. When talking about investment flows and global shocks, exchange rate flexibility plays an essential role, because the exchange rate becomes the shock absorption factor per se. Therefore, it plays a very important role. In order to keep this exchange flexibility as you know it today, the exchange rate flexibility in Colombia may sometimes be volatile. We do not take any interventions, however. However, we take into account certain bands in order to, well, feel assured with the flexibility achieved. The fact that we have this inflation targeting regime anchored to long-term targets has become critical so that we can allow for free floating. the exchange rate pass-through to inflation should also be relatively low and under control. And if there are any economic mismatches, well, they should also be limited. We are exposed, but only to a limited extent. And these risks are low if we take into account assets as a whole. We also take into account any potential mismatches in Colombia among households, and that risk is therefore quite limited. There are not foreign exchange mismatches that should worry us. As a result, we can allow for exchange-free floating and we can absorb global shocks adequately. We act under very specific circumstances. The last time we did so in order to build up international reserves because we thought that there was going to be a reduction in the amount of 1.5 billion euros concerning the IMF flexible credit line. This was a small package, and as Alonso mentioned, during the COVID-19, we took this action in order to stabilize markets, and foreign investors accepted that we are a central bank that allows for free floating or for the foreign exchange free floating. So when factoring in risk, they are aware of the fact that we are not going to intervene at all. They therefore undertake or assume risk according to this approach, and there is a positive collateral effect of this exchange rate flexibility. This dovetails with exchange rate hedges. Since we do not actively intervene in the market is aware of that, and therefore the market players pay good attention to that decision when it comes to assuming risk. And that leads to private stakeholders to take out their own hedges. In Colombia, we see that this has sort of grown significantly over the past few years, and Colombia has therefore been motivated, and we feel quite satisfied with our policy-making framework because we believe that it fosters local financial markets. Thank you very much. Let me turn to Alonso. And what Andres mentioned before when talking about credible policy-making frameworks, considering inflation targeting regimes, external buffers, and flexible exchange rates. What lessons can the Banco de Costa Rica take from this, especially when foreign investors live persistently and not in a very orderly manner? Well, I think that we have many lessons to learn here. Andres' presentation was very thorough, and I believe that he pointed out many things that we had to aim at in the short term. For example, hedging. Historically speaking, and due to our exchange rate regime, despite the fact that over the past 20 years it has been increasingly more flexible, it's still not flexible enough for market stakeholders. And as you know, credits and deposits are mostly dollarized. So I think that this is an urgent matter that Costa Rica has to attend to in order to keep on developing its economy. there has been a currency appreciation over the past 4 years. You know that capital flows come from exports and FDI mainly. And then exchange expectations. Now depreciation has cooled a little bit, and markets have been accommodating themselves to this volatility. In my opinion, it's very important for investors to understand these risks, make them their own, and that is where we see some room for growth. We are also trying to facilitate domestic bond issuances in order to allow for foreign investor participation. And just recently, some euro-denominated issuances have taken place, and we see foreign investors buying those bonds. But again, this is relatively new. Many flows are concerned with foreign debt, and over the past year, we have observed no issuances, no Costa Rican issuances in the international markets. I think that the IMF flexible credit line granted to the country was a very positive sign. When the Central Bank of Costa Rica requested this credit line, we asked for around 1.5 billion US dollars. We have not drawn down on such an amount. Nonetheless, banking reserves have grown by far more. So the central bank has experienced this reserve increase. We have been buying more reserves just recently in order to achieve financial shielding, and this year the currency appreciated more compared to prior years, and I think that this is very important. I believe that this follow-up on foreign and domestic investor participation is critical when it comes to making public policy decision-making. These are some of the banks that work in the country and that have different resources available. The central bank can also intervene in the secondary market. This is permitted by law. In the past, it was not possible. And therefore, the overall regime is right now much stronger. However, we have to further develop local financial markets and hedging instruments in order to participate more actively in the international markets, and maybe at some point down the road in other markets as well. Well, thank you very much. I think that it's good that you're moving in that direction. Let me turn to Andres. The document points to lower global risk transmission after the drop in foreign investor participation since 2023. This effect depicted in chart number 3 is showing a cyclical adjustment associated to global conditions, or do you think that we are in the face of a structural change in the Colombian financial integration that has a direct connection with local conditions? Well, thank you very much, Yader, for the question. Well, let me be honest here. I don't know. I don't know whether this is a structural change or a cyclical change. I couldn't tell. But I would say that we did see some significant changes in the investor composition. This is not fully covered in the research paper. So we observed some players living in a more sort of structural fashion. Monetary authorities that may prefer long-term horizons. Incoming investors came in through the Colombian government bonds channel, or the so-called Colombian TES. So I think that this is quite interesting, and we have to understand this well. We're not talking about the same agents. On the one hand, the big sort of benchmark-driven investors left the country, and we see more hedge funds coming in, or more volatile players, more short holders taking advantage of interest rate spread conditions, comparing Colombia with other countries in the region. And we also see these, players having shorter term expectations. We therefore need to understand this change in the investor composition. I don't know whether this is going to be persistent or not, but we are certainly zooming this market in because we think that we need to keep a close eye on it. I believe that this is a significant change that is here to stay for quite some time. I'm talking about investor composition and sensitivity to global financial conditions. Thank you very much, Andres, and thank you very much for such an honest answer. We have time for one final question for Alonso that is also concerned with the outcomes of the paper that was presented today. And this has to do with the Costa Rican economy. And this is something shared by other Latin American countries. So sensitivity of local interest rates to global shocks may lead to increased foreign investor participation. But when talking about a relatively small economy such as Costa Rica, which is also a dollarized economy, how should we manage long-term rates and detach them from domestic monetary policy? Taking into account the policies applied by developed countries as well. Thank you very much for the question, Yader. In general, monetary policy challenges for a small economy are huge, especially when such an economy is dollarized. I should say that this degree of dollarization today is lower compared to 2 or 3 decades ago. In this regard, we are facing a lower risk, and this has been a favorable development. But this takes time for both the home currency and the foreign currency, and many exchange denominated deposits are not reacting to rate variations. They may react, however, to external shocks. Against the recent context, we observe that foreign short-term rates tend to be higher to home rates or domestic rates, which right now stands at 325, whereas the Fed applies higher rates. Such variation, or how we have equated or even surpassed the Fed's rates in responding to our inflation targeting targets, our policies had to move in that direction. And this was quite a significant risk. And then we have other portfolio considerations, not so many internal or external flows considerations, but rather the approach taken by local investors. Therefore, we do need to take all this into account, like rate spreads, because they can affect monetary policy. I do not have a final answer or a very concrete answer, but I think that we have to continue enhancing our inflation targeting regime, weighing risks without creating too big a difference that might lead markets to react not based on our inflation targeting targets, but rather because of very high rate spreads that may lead to portfolio fluctuations, leading to foreign exchange market volatility, which is not supported by any economic fundamental. Thank you very much, Alonso, for your answer. And Costa Rica is right now spearheading many monetary policy initiatives. We have run out of time. We have to finish now. Thank you very much, Andres and Alonso. Thank you very much for accepting our invitation to participate at this webinar. Thank you very much for sharing the outcomes of this research paper. And thank you very much to all our attendees for attending this webinar. And we look forward to seeing you all again at the next FLAR webinar. Thank you.